welcome to the accounting class. In this session we're going to introduce you to an important financial statement. This statement is called the balance sheet. The balance sheet is simply another way of setting out the accounting equation. If you can remember that equation, assets are equal to liabilities plus equity. What we do when we set out the balance sheet is place our list of assets on the left and our liabilities and equities on the right. The two sides, left and right, should come to the same total. In other words, assets should balance liabilities and equity. This is where the name balance sheet comes from. So let's start with our assets. What in fact are assets? Well, assets is basically anything that is owned by the business. And we usually list our assets in order of what we call decreasing liquidity. That is, how easy it is to turn an asset into cash. So, not surprising, what's top of the list? Well, of course, it's cash. So, a typical order then for assets would be to start off with cash, then accounts receivable, that's money that's owed us, then prepayments, things which we've paid for in advance, possibly insurance for the year, and then things like equipment, plant and premises. On the other side we have the liabilities, so let's look at those. Liabilities are things that we owe. That might be money that we owe to suppliers who we've yet to pay. It could be money that we owe to the bank if we've taken out a loan, or it could be money owed on a mortgage which we've taken out to help purchase a property. We group liabilities as being either short-term or long-term, or sometimes you may see the term used current liabilities. Now, current liabilities are liabilities that are likely to fall due, in other words, money we have to pay within the current financial year, whereas a long-term liability is one that is not payable in the current financial year, but payable at some date after that. Lastly, in the accounting equation, we have equity. Equity is really a way of measuring, or recording, if you like, the value of an owner's interest. Now, in a business where there is only one owner, we often call that capital, right? So there, capital and equity are really talking about the same thing. If you have a partnership, we still call it capital, only it is important on the balance sheet then to set out the capital for each partner separately. Now, in a corporation, it's slightly different, because ownership is represented by common stock. And that's what you will normally see as the equity on the balance sheet, common stock. So all of these things then make up our balance sheet. Remember, assets we set out on the left, liabilities and equity we shall set out on the right. Now let's look at a very simple example. So here's our first case study. Hans decides to start a business. It's going to be a repair shop. He's got $50,000 and he invests this in his business. What we're going to do is look at how the balance sheet is affected at a number of steps that he might take right at the beginning of starting his business. To start with then, Hans of course has no liabilities. He has an asset of cash, the $50,000, which he has placed in a bank account. And his capital then is also $50,000. So those two are going to balance, our balance sheet balances. Hans now makes a purchase of equipment for $10,000. He pays by cheque. So what we want to see is how buying that equipment for $10,000 has affected the balance sheet. Well, of course, you can see that what's happened here is that he now has this new asset of equipment for $10,000, but of course his cash has gone down by $10,000. But if you add up the two sides, you will see that the total on the right hand side still balances with the total on the left hand side. Hans now decides that he needs a little more cash, so what he does is he takes out a bank loan for $30,000. So this is his first liability, and we've got to see now how that liability is going to affect the balance sheet. Well, you can see that what's happened here is that the cash has increased on the asset side, and of course there's been a liability now introduced on the left hand side. Add up the right, add up the left, they will still balance. Many businesses will buy and sell goods on credit. So what happens if Hans buys some goods on credit? Let's assume that he spends $5,000 on inventory, in other words goods he will use in his repair business. How is this going to affect our balance sheet? Well, what we've done is we've introduced our new asset, inventory, on the left. And we've introduced our new liability, accounts payable, on the right. But our balance sheet, of course, remains balanced. Finally, in order to be a financial statement, we need to add certain things. We need to add three important things at the top of our details here. Our details are the name of the business, the name of the financial statement, in this case the balance sheet, and finally, because it's a balance sheet, the date on which it is prepared. Balance sheet is very much like a snapshot of a business. It tells you the position of a business on the date that the figures were taken and extracted and used. So finally, remember, provided that you have always extracted the correct details, and provided that you have entered them in the right place on your balance sheet, it will always remain in balance. Thank you for watching.